So we just heard the Fed is actually stopping quantitative tightening. And that is a big thing, and a lot of people don't even understand what quantitative tightening even is or how it can affect the market. And that's why I'm here today to explain what quantitative tightening is, how it will affect the market in 5 easy to understand bullet points to kind of make this as smooth as possible, because we got enough complicated things to deal with the stock market, and understanding things like quantitative tightening or easing can be a little complicated, especially if you're a novice. So we're going to talk about it right now, so that way you can feel more informed on what this even means. So, quantitative tightening. So, let's define what quantitative tightening is. It's essentially when the Federal Reserve shrinks its balance sheet by letting bonds roll off, or in other words, mature, without replacing them, or by actively selling them. So, I guess in the most simplistic terms, you could say that QT, as I'll refer to it for the rest of the video, is the Fed pulling money out of the financial system. So, they're taking money out of the market, theoretically, right? As a result, this will theoretically reduce liquidity. It pushes borrowing costs higher. Again, this is all in theory, in a bubble. And it acts as a form of monetary tightening alongside higher interest rates. So typically in the environment where we see interest rates go up, we typically have quantitative tightening. It's not always, obviously. Same thing with quantitative easing. But at least in this perspective, when we see QT, we typically see rate tightening as well. Now, when the Fed stops QT, because we just stopped QT, how does it actually affect the stock market? Which is, I'm sure, is why you're watching, what you want to know. And I have 5 bullet points to make it pretty simple. Your liquidity increases. We just talked about how QT can decrease liquidity. So instead of pulling that money out of the financial system, we're just not doing that anymore, right? As a result, it's going to be a direct tailwind for risk assets, essentially. So ending the QT is going to remove a major drain on liquidity. More liquidity in the system as a whole generally supports higher equity evaluations. So consequently, especially those story stocks, especially those stocks that haven't necessarily turned a profit yet, those stocks tend to benefit from no QT. There is lower pressure also on long-term interest rates. So we just talked about how QT can pair with tightening monetary policy. QT tends to push the long-term treasury yields higher. So if stopping QT does the opposite, that can theoretically boost stocks or equity in general, particularly those very high growth rate sensitive sectors I just alluded to. Again, your story stocks, the smaller companies, your IWM, right, Russell 2000 stocks, those are more than likely the ones that you see a positive effect from QT ending, right? Third bullet point is that it can improve financial conditions in general. Credit spreads may tighten, so that consequently makes borrowing a little bit easier, theoretically. And corporate financing confidence improves, which typically is a bullish signal for equities. If people feel more comfortable borrowing money, then there decreases the risk of companies going bankrupt, right? Consequently, equity prices they don't have a ceiling on them, so to speak, because there's lower risk of those story stocks getting hit as hard, theoretically, causing a more than likely bullish tailwind effect for stocks. Your fourth point is that Fed shifts, or should say potential Fed shift in sentiment, can be interpreted as a dovish action, right? So we've already seen interest rates cut recently, so ending QT theoretically could support that narrative even further. When QT ends, it typically signals that the Fed is more comfortable with the economic stability of the country as a whole, to some degree, and how inflation is trending. Theoretically, markets would typically price softer policy path in general, so we're typically pricing in the odds of more cutting or not raising rates at least, right? Which can boost momentum for the stock market in general. And lastly, inflow to equities. We should see inflow into equities as we see bonds start to stabilize. So if the treasury supply pressure starts to ease up a little bit, bond volatility theoretically will drop. So that comes off the back of economic stability increasing and people feeling more comfortable with corporate financing. As a result, predictable, or they should say there are more predictable yields as investor appetite shifts back towards stocks, because during the time where we're in a period of we're really tightening down, we're raising rates. There's quantitative tightening, so money's leaving the market. You see a lot of bigger money go into bonds for safety. It's more secured, right? You're trading treasury bonds or whatever. You're getting your guaranteed 3, 4, 5, 6, 7, however much percent, and you're not looking at stocks as a means to make money. I mean, of course you could, but you shift your risk over this way. Now that quantitative tightening is ended, some of that risk can shift back towards quantitative, not an easing necessarily, but back into riskier assets theoretically, because it's signaling that the Fed feels a bit better about its position in terms of a risk portfolio, or from a risk point of view. So essentially, that's what you need to know and understand about quantitative tightening, what it is, and how it can actually affect the market here in the near term, especially towards, again, those higher affected companies, your Russell 2000 companies, a lot of those companies that need to borrow more money in general that don't turn a profit yet, those are more than likely the companies that are going to be affected most of the ending of quantitative tightening.